Today we're going to be talking about comprehensive asset care and some full service policies provided by a company called OneAmerica. OneAmerica, you may have also heard of their underwriter State Life, is a company that I wasn't really familiar with until recently. I've gotten to know them a little bit better, gotten to get a feel for what they do and how they do it, and it's pretty exciting stuff. So we wanted to talk to you guys about that and get you all excited as well. So why are we saying be comprehensive? What do we mean by that? You know, we're the Independent Life Insurance Agent Association, the ILIAA, and that's enough letters. If we wanted to really cover everything that we want to talk about and we want to help use to protect our clients, we'd need to be the Independent Life Insurance and Annuity and Long-Term Care and Medicare and Health Coverage and Drug Plan, etc. Agent Association. And that's it's hard enough to say the ILIAA as it is. So, forget all of that. But even though we're just the ILIAA in name, we have to admit that life insurance by itself can leave some gaps. Whether you're going out and getting just a cheap term policy to cover a temporary need for the next 10 or 20 years, or you're getting something more comprehensive or a larger policy that's going to build some cash value or whatever, it's life insurance by itself is not a comprehensive solution for everything that you might run into. You tend to give up either some asset growth or some protection against long-term care needs by going strictly with a life insurance policy by itself. And that's not a universal truth. There are such things as indexed universal life insurance policies or participating whole life policies that have strong asset growth. There are policies that have riders that you can use to accelerate benefits in times of critical illness or terminal illness. And that can provide some long-term care coverage as well. But typically, if you're looking at a policy like an indexed universal life policy and going for that strong asset growth, you're also in the back of your mind remembering that taking out too much of that policy is going to lapse the policy and it's going to leave you up the creek if you needed to use it for other things. So some of this stuff, even though it can be done under life insurance, it's a give and a take. And there are some gaps that are still left that you might want to look at filling. So why does all this stuff matter? Well, we've got a little video that I want to show you guys. It's from OneAmerica, and it goes into a little bit of the logic why long-term care is a necessary thing and why it's something that's great for your clients. So let's take just a moment. That's 2 or 3 minutes long, or 3 or 4, I forget, and we'll watch this together, and then we'll get back to our presentation.
Is your future worth protecting? Think for a moment about certain risks in your life and the steps you take to protect yourself. One house in 335 catches fire every year. To cover potential losses, you buy homeowners insurance. One car in 52 is in an accident each year. Auto insurance protects you from loss and liability. One person in 1.4, age 65 and older, will need long-term care at home, in an assisted living facility, or in a nursing home. It's commonplace to protect your car and your home. Why not take steps to protect your retirement future? Your future is a valuable asset, after all. You don't think twice about protecting your car with insurance. You protect your home and everything in it. Why not take the same care to protect your future? Think about this powerful statement from well-known elder care attorney Harley Gordon, who has spent his career assisting those in need of long-term care. Extended care, or LTC, is not a condition or a place, but a life-changing event that would have devastating consequences to your loved ones and your ability to keep financial promises during retirement. Not being prepared for healthcare events may have a big impact on your spouse and family members. Your spouse, children, or other loved ones tend to carry the burden of providing long-term care for those who aren't prepared, and caregiving responsibilities may add stress, strain relationships, and/or cause the caregiver to become ill as well.
Well, let's stop it there because the rest of it is kind of talking about their products, and that's what I want to do. So the point that the video was making just then is that long-term care, you saw 1 in 1.4 people age 65 or over are going to incur some kind of long-term care expense or have some type of long-term care need in their life. That's a tremendous number, and I don't think that 1 in 1.4 people have adequate long-term care insurance. So when we're talking about this stuff, we're talking about a huge market that is readily available to be tapped. and as we're going to see, can be serviced with some really interesting products here. So One America, and by the way, the video we were just watching is one of One America's consumer-oriented videos. As an agent with One America, if you were working with them, you'd have access to videos like that for most of their products. They've also got like social media campaign starters, radio scripts if you wanted to run radio ads, a lot of brochure material. Just as far as product materials and marketing materials go, they've got a lot of stuff right off the shelf that's really useful. It's a really cool company. But back to the point, the Asset Care product portfolio that One American has is really neat. It protects against long-term care expenses. It's a life insurance based product that protects against long-term care expenses. You've got access to 100% of your life insurance death benefit for long-term care needs. And you can, sorry, dogs were a little nuts. You've got an optional lifetime long-term care coverage rider where premiums never rise. It provides a wealth transfer vehicle, options for cash value growth, and this is all available on a single or joint life basis. So you can issue this on a single person, you can issue this on a couple. If you do issue it on a couple, just keep in mind that the death benefit stuff won't trigger. Obviously, it's a second to die policy, won't trigger until the second person passes. The long-term care benefits, if either person in the policy needs it at any point, that's that's going to be available to both of them, so long as the policy still has value in it. So at a glance, there's 4 products in the Asset Care portfolio, and depending on what your client needs, one of the 4 is hopefully going to be a solid fit for them. There's Asset Care 1, 2, 3, and 4. Asset Care 1 is, and to back up for a second, all of these have the benefits we were just talking about, the cash value accumulation, long-term care benefits, etc. This is just the different chassis that these policies can be built on. This is one of the cool things about it. When we look at something like a Lincoln MoneyGuard, for example, which is one of the first things a lot of people think of when they think of a linked benefit plan. There's only so much you can do with Lincoln MoneyGuard. It needs that big dump in. It needs to be, needs to sit untouched for a while in order to do anything useful. And it's built on UL chassis, and it's got its own caveats there. All of the life sides of these products are built on whole life chassis. So there are stronger guarantees out of the gate, and the different funding options and structure options that we're going to talk about here gives your client a lot of flexibility when it comes to how they're actually going to get money into this policy. And that in turn gives you a lot of flexibility in who you're able to take on as a client. So Asset Care 1 is your standard single premium whole life policy, minimum $10,000 dump in, and it just works pretty much how you'd expect a single premium whole life policy to work, with the additional long-term care benefits that we're going to go into a little more detail about here in a moment. Asset Care 2 and 3 are a little interesting. They're annuities that are set up to annuitize and pay into a 20-pay whole life insurance policy. And that whole life insurance policy has an accelerated death benefit, of course, for the long-term care expenses, just like the others. So Asset Care 2 is for non-qualified funds. Asset Care 3 is for qualified funds. So depending on where your client is funding these from, one or the other may be appropriate. The cool thing about this is that it maximizes the impact of your client's initial dump in. You may have heard of this strategy, using an annuity to buy a life insurance policy called annuity arbitrage in the past. And it's a really powerful thing to do. Instead of just taking a single amount of money and dumping it into a life insurance policy, use that money to buy an annuity. Then take the payments from that annuity and use those payments to purchase a life insurance policy. That way you get the benefit of the growth in the annuity, the growth that's then paid essentially into the life insurance policy, and you end up with a larger policy than you would have been able to afford otherwise. And the way that One America structures this, you have really kind of a rolling long-term care benefit all along the way. This is a 20-pay whole life insurance policy. At the heart of it, these annuities, whether you go 2 or 3, qualified or non-qualified or qualified, either one is going to end up paying off a 20-pay whole life insurance policy. So during that 20-pay period, if you need a long-term care benefit, you'll be drawing partially from the annuity value, partially from the life value. So it's balanced all along the way to make sure that you've got continued growth, continued guarantees. It's really well structured. I like this product a lot. Asset Care 4 is it's a more traditional whole life policy, either with a lifetime pay, and it's your standard monthly, quarterly, annual, whatever payments up to age 100, or you can do it as a 10 or 20 pay. All of these products are going to have these cool long-term care benefits like we talked about. So let's look at each one in a little bit more detail. Asset Care 1, you'll remember, is a single premium whole life policy. It's got a return of premium number one. So if at any point you want to get your money back, it's fine. Just get your cash back. Minimum 4% interest rate as well. So that, that's a pretty decent floor on a declared rate insurance policy. You're getting minimum 4%, and you could do better than that. The return to premium is nice as well. That's a big thing that a lot of people look at with Lincoln Money Guard. They say, well, you can just get that return to premium benefit triggered at any time if you're not happy with it and get all your money back. You can do that here too. And I think if you go through the product and you compare it side by side to Lincoln, you'll see that you've got something more affordable and with stronger guarantees here. Now, the long-term care benefit with Asset Care One and with all of these products is going to be 2% of the death benefit per month. So depending on the size of the death benefit, depending on the amount of long-term care that your client needs, that may or may not be an appropriate amount for them. You've got the option to increase that to a 3 or 4% rate. So instead of just paying out 2% of the death benefit per month at maximum, you can, for an additional premium, you can increase that to 3% or 4%. It's not a lot to increase it to 3% or 4%. It's such a nominal amount that I can't imagine not doing the 4%. It's a few bucks more. It's really nothing at all. You can also get a continuation of benefits rider. Maybe if you're running a long-term care benefit at 2, 3, or 4% of the death benefit a month, eventually you're going to deplete that death benefit and deplete your long-term care benefit as well. If you have the continuation of benefits rider, you can extend those long-term care benefits to provide additional coverage past the point the policy would have been depleted. We'll talk a little bit more about that rider at the end of the webinar. And with all these policies, when we're talking about long-term care payments and qualifying expenses, we're talking about long-term care facilities, assisted living facilities, and home care. Now, and the fact that they're willing to pay long-term care benefits on home care is pretty big. You don't find that with absolutely every policy out there. And home care is one of the more common and becoming more and more common ways that people receive long-term care. So it's really, again, I can't say enough good stuff about these policies. I really like them a lot. As far as just access to the cash value across the life of the policy, outside of a long-term care need, you just want to get some of your cash value out. Policy loans come out at 4% net. You can take the accumulated interest from your policy at any time without surrender. Obviously, there's going to be a tax consequence for that. If you're touching the cost basis, it starts off at 11% surrender charge. It decreases 1% a year for 10 years until you get down to that 1% surrender. Access to the cash value, we say it's a 4% net policy loan. The actual rate of the policy loan, I think, is it's 7 or 8, but the minimum 4. They credit you on they credit you interest on the policy as though you hadn't taken the loan out. So the amount you take out as loan is offset by the amount that you're gaining on what's in the policy. So it evens out to 4%. The actual interest rate on paper is a little bit higher. All right. Excuse me. All right, so Asset Care 2 and 3, these are the ones that are built on the annuity chassis and that pays into a whole life policy and ultimately becomes strictly that 20-pay whole life policy. They still have the same return to premium benefits, 4% floor on the life policy. On the annuities, you're guaranteed at least 3%. Life-based long-term care benefits, so the long-term care benefits that are paid out of that 20-pay whole life policy, they increase over your 20-year premium payment period. So, and the premium remains level. So early on in the policy, if you're only a year or two into it and you need to trigger the long-term care benefits, most of it's going to be coming from the annuity value. If you're later in the policy and more of that value has been paid to the life insurance, most of the long-term care benefits will be coming off the life value. Makes sense. Long-term care benefits are the same as Asset Care 1, except instead of paying 2% of the death benefit per month, it's 2% from the annuity, 2% from the life insurance as appropriate. It just depends on where you are in the life of the policy and the life of the contract. At the end of the day, it's the same benefit, and you've still got the same options with the continuation of benefit rider and to increase that to 3 or 4%. Access to cash value in the annuity, you can do 10% annual withdrawals, but keep in mind, this is really important, keep in mind if you're taking cash value out of the annuity, when you're calculating those 10% annual withdrawals, the amount that comes out to pay your life insurance premiums, remember these annuities are funding the 20-pay life insurance policy, that amount counts against your 10%, so it's a little bit less liquid than you might think. When you get to the life insurance side of things, it's the same as Asset Care 1. 4% net loans, yada yada. Asset Care 4 pretty much works exactly like you'd expect at this point. Same long-term care benefits, standard whole life policy, just starts off as a whole life policy and kind of stays that way. So it's got all the cool long-term care and return to premium. Well, I'd have to double check. This one might not have the return to premium. Got the same long-term care stuff that all the others do. And it's either your standard monthly or annual, quarterly, whatever, paid 100 whole life insurance, or you can do it on a 10 or 20-day basis. We mentioned a couple of riders. There are two that are pretty cool. And this is outside of the increasing the payment from 2% of the death benefit to 3 or 4%. You can do that just as a policy option. And again, it's just a very nominal increase in premium, very, very worth it. You can also add inflation protection, either 3% or 5%, and either simple or compound. So 3% simple, 3% compound, 5% simple, 5% compound. Those are all options available to the client. What this does is make sure that the amount of your long-term care benefit increases over time, so that if you buy a policy now, 20, 30 years from now, it's still something that's useful to you, and that monthly benefit that it could pay out for your long-term care needs is still something that would actually cover all your long-term care expenses. And you can see the little example chart here. If we had a client at age 60 with a base monthly policy benefit of a limit of $3,000, with no inflation protection at age 61 or age 80, it doesn't matter. He's looking at $3,000 a month. If we had an inflation protection and triggered that benefit at age 61, if you had a 5% simple interest option, we'd see $3,150 a month. If instead he triggered it at age 80, 5% simple, we'd be looking at a $6,000 a month benefit. As you can see, that's double what we would have had without the inflation protection. And if we had compound growth, we even got a little bit more. At age 80, we're almost up to $8,000 a month. So obviously the 3%, 5% simple, compound, whatever, this adds a little bit to your premium, but it makes sure that your policy stays more relevant for a longer period of time. It's pretty cool. I think it's worth it. Continuation of benefits rider is another thing. Remember what we're looking at here when we're triggering long-term care benefits is essentially accelerating the life insurance policy. We're taking 2% or 3% or 4% of the life insurance benefit each month and paying that towards long-term care costs. So after a while, we're going to run out of life insurance benefit. A continuation of benefits rider means that the company is still going to continue paying long-term care benefits even after the point where the life insurance policy that's funding your long-term care benefits has been reduced to zero. You can do this on a limited basis or a lifetime basis. Lifetime option, does what it says it does. Once you trigger the benefits, are going to pay at that level for life. Limited benefit, you can add a little bit of extra coverage above and beyond the life of your policy, and the amount that you would get if you choose the limited option is based on the max monthly long-term care option that you selected. So if you selected 2%, you get an extra 50 months. If you selected 3%, you get an extra 33 months. 4%, you get an extra 25 months. So limited or lifetime, either one. This is a cool rider, depending on the age and health of your client and what exactly they're looking to get out of the policy. This might be something that they'd like to look at. This does get a little bit more expensive, but the additional benefit that it provides is pretty obvious. So without getting into a lot more nitty-gritty about how these policies work in different markets and sitting here and just reading product brochures to you, that's where we're going to wrap things up. We do have marketing materials, product brochures for this stuff, agent guides. If you're interested in these products, we'd love to send them to you. Like we said, this is a company that until maybe a month and a half, 2 months ago, wasn't really on our radar, and we've found them, we've learned more about them, we're really interested in them. They have a solid suite of products from what we can tell. We've talked to a couple of agents that have been writing products with them, that enjoy doing business with them. Their clients are happy. And from what we can see there, and hopefully from what you guys can see in the webinar today, the stuff they offer is pretty innovative, pretty neat, and pretty strong. It provides great long-term care benefits, great asset growth, asset protection, wealth transfer vehicles, and that death benefit from life insurance policy as well. We used to sing Lincoln Money Guard's praises because we're big fans of linked benefit policies. We're big fans of putting your eggs in that basket and saying, yes, this is my policy for life and long-term care, burial, and da-da-da-da-da. I think this is like Lincoln Money Guard, but even better. And I think the way they've structured their policies on a whole life chassis instead of universal life chassis is the way to go. I think if you run hypothetical illustrations, compare what you get dollar for dollar, this versus Lincoln MoneyGuard, you're going to find that One America's products tend to come out ahead in terms of the amount of benefit your client gets and just the bang for their buck that they get. So I'm pretty excited about these guys. I hope you guys are too. If you want to learn more about them, if you want to get more detail about them, feel free to reach out to us directly. We'll be happy to send you any product guides, brochures, agent guides, materials, marketing materials, whatever you might like. And if you want to write business with these guys, give us a call, shoot us an email. We can help you do that as well. So thank you guys all for coming out today. We enjoyed it. Hope you did too. And as always, look forward very, very much to seeing you all next time. Thanks, everyone.